Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from the wealthyhomeowner.ca. Welcome back to the show, Ross.
Thanks for having me back, Jim.
Ross, the conversation in the news the last couple of months has focused on the housing market's renewed activity levels. What exactly is causing this renewed activity? And I've noticed they're always saying, well, it's a 42% jump over last year. Again, are we being misled?
You know, it's a great topic today, and it's kind of timely for me personally, Jim, because I was out. My daughter and her boyfriend took me out for a beer there the other day to say happy birthday to good old Dad, and this sort of a conversation came up, and so I think this is really timely, and it also is going to result in some personal perspective, me bringing into the discussion here. I'm talking to my daughter. She's now, she's 24 years old. She, grew up with, 3 brothers, and my wife, of course. And, so she is, a little bit of a unique girl. I mean, she was raised with 3 brothers, so she's able to hold her own in, many ways, with anyone. Her perspective is just a little bit different than, what most of us, grew up with. I'm sitting there talking to her and her boyfriend, and we're discussing about life goals, and we're discussing about my own family's history and when she was growing up, and she's trying to communicate some of the things to her boyfriend, who was basically an only child, and grew up in a different family setup than what she did. But there's some parallels that seem to really have been consistent over a long period of time as Canadians. And, I think that's kind of one of the reasons why you're asking me this question. Is this renewed activity again? Or what is causing so-called renewed activity? Or is this 42% gain really a 42% gain? And it goes back to your discussions with your children. It's funny. One of the hardest things for a parent to discuss with their children is when the discussion of sex comes up. You know, one of the most fundamental aspects of our life. Yet when your child gets to be that age, 9, 10, 11, where those questions start to come up, as adults, we become very uncomfortable answering those questions. It basically takes a generation or two to work through, so you're able to handle those type of situations easily. Now, in my family's case, my mother had that discussion with me when I was a young boy, and my sister. It wasn't my dad who led the conversation. And my daughter growing up with 3 brothers and a dad who's quite opinionated and vocal, and a mother who basically ruled the roost. She had these type of discussions commonly in the household, so none of these things were unusual for her. Yet her boyfriend, these conversations didn't come up. It was not something that was ever discussed at home. Then we got into the discussion about drugs. Well, you know, drugs is another conversation that parents have a hard time discussing with their kids. It's hard to be frank and honest because we weren't treated that way by our own parents when they were discussing drugs with us. So it's another learned skill that, you know, for the majority of parents, it's just not common. So the children go out and they seek the answers in other places. They seek their answers in other places for the sex discussion and the drug discussion. And then we get into the third topic. The third topic, which is just as equally as important and is fundamental about life, and that's money. That's how you interact with money over your lifetime and how the decisions that you make today will impact you when you're getting ready to retire. And money is really another one of those topics where parents don't have this discussion with their kids. So because these discussions don't take place, it leaves us as people open to manipulation by others. It leaves us open to believe stories that are not necessarily true. And it leads us often in a direction that is designed solely to benefit someone else and not us. And this is really what probably with this housing discussion where the problem is. When a family purchases a home for the very first time, they are taking on an extreme amount of debt, a level of debt that they will probably never take again in their lifetime. When they trade up to homes later in life, odds are each of those successive trades will not be taking on as much mortgage debt as they do with the very first home that they purchase. Now, I want to let your listeners know today, this is no different for people buying a house in the 1980s, the 1990s, or now in the late, as we head into 2020. There are those periods of times where we're all the same. People were taking on a monumental amount of debt that they were going to have to repay buying their first home. So when I'm discussing this with my daughter and her boyfriend, and we're talking about their life, we're looking at their job. And we're looking at their jobs and what they're making. And they both are quality people. They have quality jobs. But they are not going to make the money that I was able to make selling real estate for my lifetime. And I don't foresee, even though my daughter's a great salesperson in the job that she's in now, I don't have the confidence in the real estate industry to tell my daughter to get into the old family business. And I also, as your listeners know, I have a major gripe with how real estate is bought and sold and how the consumer is manipulated in today's real estate market. But in their situation, they are really not in a position where they're going to be able to work their way through the property ladder in the Greater Toronto area. It is not going to happen. So what that means is the hometown of my daughter and her boyfriend that they were born and grew up in, they are not going to be able to enter the property ladder and live a fulfilling life based on the income levels that they're able to earn. And these are okay income levels. These are better than median income level. It's not going to work out. So the only way that you can convince someone who's knowledgeable and anyone who applies even a minor amount of critical thinking is to lead them down a path or have them believe things that aren't actually true. And this is how organized real estate has been built, and it's a fundamental foundation that it's built upon. That is misleading the consumer for producing magician tricks. Look at the shiny bauble, but don't look at all the strings that keep that bauble in the air. Your housing market levels, the activity rate, which is what we call it, and the trading rate, which is another term that we use. We measure both of these metrics, and we have measured them over time. These are specific housing market metrics that tell you whether or not a housing market is actually busy or not. The trading rate itself will result in the amount of house price gains that are able to be achieved, or the amount of, or how quickly house prices decline. The activity rate tells you what forward projections in the housing market are going to be. These two metrics in no way represent the stats released by organized real estate that claim a 42% house price gain, an increase in activity of 42%, or 25%, or 10%, because they're looking at how home owners have interacted with their homes and the housing market over the last 40 years. They're not looking at a specific moment in time for a talking point. This renewed activity that you're hearing talking about was the exact same renewed activity Ontario homeowners were told about in 1991. The realtors were out in the marketplace in 1991 after the housing market was into a full correction, bragging about housing sales increasing again. The same thing happened in British Columbia just earlier this decade. Your organized real estate is out bragging about sales gains at the same time that the actual activity rate in the market was below historical norms. Not only were they below historical norms, Jim, but they're below what is the level of activity that is required for housing prices to maintain themselves. Just last week, the Toronto Real Estate Board was claiming that the average selling price in Toronto was up like $40,000. They're saying this at the same time, at the granular level. Actual homes were worth less this September than what they were worth last September. The composition of sales changed, which is always changing, which does not follow a calendar year, which is why you never report on housing markets using annual or seasonally adjusted rates, because you need to make the changes for the cyclical nature of the housing market, which doesn't follow a continual cyclical pattern. What your listeners have been told today are the same fairy tales that children are told about how babies arrive in the 1960s. Babies arrive from a bunny. A bunny delivers the baby for you. Housing markets magically get busier again when the housing market isn't actually getting busier. It's okay marijuana is safe, but you don't hear that it's safe after you're 23 years old. Up until 23 years old, it can affect your brain. We can't talk rationally to our children about marijuana when they're 14 or 15 because we don't trust them. We don't believe we can give them the data and allow them to make a rational decision. I believe you can. I believe that you can show people the truth about a housing market and they can still make a rational decision whether to invest in it today or to hold off and invest in it at a later time. I know the advice that I'm going to give sooner or later is going to be invest in the housing market. I know that is going to be the advice that we're going to give. The only difference is when you're making that decision, you are going to be entering the market using data and relevant metrics of a housing market that tell how the housing market is working truthfully to you. You're sitting there seeing the numbers in front of you and you can make a rational choice. There is no need to go out with a clickbait headline, home sales increased 40% year over year, when we're talking about an all-time record low activity level the year before. This is like measuring water in the Great Lakes. My parents live on Georgian Bay now. That's where they retired to. 40 years ago, when they first purchased that property, the water level on their shoreline was exactly as high as it is today. It took 40 years of that water level declining each and every year and then increasing each and every year for the full cycle to repeat itself. Even the experts cannot fully explain how that cycle works. I know I can't. I know I've looked for the research and tried to find the reasons. I know that they talk about there's a river that empties from the Lake Superior and Lake Huron into Lake Ontario or Lake Erie that has a reduced water flow. I know that the Great Lakes Water Commission regulates the amount of water that is let through the St. Lawrence Seaway, but you still can't see any data that proves how this cycle was or how it worked. All I know is everyone who is talking about low water levels 20 years ago are now complaining against high water levels today. There was fear-mongering 20 years ago about not enough water, and now there's fear-mongering that there's too much water. Organized real estate is exactly the same. They want to use fear that you better buy now because the market is so hot that if you don't buy now, you're never going to get into the market. They're using fear now that the market was so low, this is the time to get in, the best time to get in. If you don't get in right now, the market is already getting busier. It's no different than when you were a small child and your parents were having a hard time discussing sex with you. We're talking about a housing market. Nobody wants to discuss the truth.
We'll have more with Ross Kay right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Ross Kay. Ross, a listener commented on a story they read about condo developers holding black tie receptions for realtors where caviar and oysters were being served in September. The listener was wondering, how much does that add to the cost of owning a house?
Well, I don't know, Jim, how much that specific event adds to that specific building, but I can give your listeners a little bit of an understanding of how the builder and the real estate broker relationship works, how it too is cyclical, and how it too is designed to manipulate the public. There is a development in Burlington, a nice low-rise condominium, which means about 7 stories, and a surrounding block of townhomes. It's where I live, Burlington, Ontario. It is a low-rise city on the outskirts of the GTA. This development is one of the best locations you could have for a new development in the Greater Toronto Area. What I've watched, that development, over the last 6 months, was an empty parking lot for 6 months. Other than the grand opening event, which may have had the parking lot half full for maybe 2 or 3 days, over the last 6 months, that parking lot has only had sporadic cars appear in it on the weekends. These builders have been holding open houses. The sales trailers have been opening. Well, the sales office has been open, and it's quite nice. Month after month after month. But they have been unable to sell their units. I'm going by the development on Saturday, and the place is packed, Jim. It is absolutely packed. And I'm looking at the cars in the parking lot, and I say to my wife, you know what they've done? And she said, well, what do you mean? Look at the cars, I said. Look at the brands of cars, the age of cars, the type of cars. She says, yeah, well, they're all really nice, new, expensive cars. I said, right, Jan. I said, who drives those cars? Who do you know, as a former Hall of Fame real estate salesperson herself, who do you know drives those type of cars? Well, real estate agents, of course, real estate agents. Regular Canadian home buyers had rejected that development in this housing market, in one of the best real estate markets in Canada or North America or the world for that matter for the last 6 months. Magically last Saturday, the place was packed. I go to my inbox and I check my inbox because you see, developers send out special announcements to real estate brokers when they're looking to get rid of their inventory. I get sent all of those from across Canada every week. When someone that is part of our network, where we collect data from, gets sent these, they just forward it to us because that's part of their agreement. Right now, as I'm talking to you, Jim, I have 18 different offers loaded up on my screen. There are 18 different offers from across Canada from new developers. These offers are to realtors. They are offers that were not available a year ago, weren't even considered 2 years ago, because the developers only work with with realtors when they have to. A builder developer does not want to pay tens of thousands of dollars to a real estate agent when they don't have to. And when their houses are selling normally, the builder doesn't need a real estate agent. When the market slows down, that's when they call, just like the Ghostbusters. They call the Mythbusters, the real estate agent. That parking lot, Jim, was packed. As it turned out, I got sent an offer sheet. It was emailed me to in a PDF on Sunday. I'm just going through my emails on Sunday, and lo and behold, there it is. What that builder did was this. That complex was not selling enough units to regular home buyers walking into the site with massive advertising budget over the last 6 months. On Saturday, it sold out one day. This is what the builder did. They raised the prices $20,000. Now, listen, folks, universal rejection of those houses in this housing market had taken place over the last 6 months until they brought in dozens and dozens and dozens and dozens of realtors who had to make car payment on the fancy cars that I saw in the parking lot parked on Saturday. They raised the prices and paid the real estate agents the full increase in price. The builder didn't lose a penny. They inflated the prices and paid the realtors all of the inflated value. Now it gets better, folks, because supposedly I have received another PDF from another real estate broker from Friday when the preliminary event was being announced as taking place. Well, as it turns out, there were some sales that took place Friday at a lower price than the revised prices that they brought out on Saturday. That's right, folks. In 24 hours, some of these units went up $20,000 in price after being on the market for 6 months and regular Canadian homebuyers rejecting them. The realtors, on the other hand, grabbed them up and were taking them to their clients to sell them as a good deal. Now, guess what, folks? The vast majority, if not all of those realtors, were not even from Burlington. Those invitations were not sent out to Burlington realtors. They were sent out to brokerages outside of Burlington, but within the GTA. Because the builder was too smart, knowing the place had sat unused or non-selling for the last 6 months, and all the local realtors knew it. So they went and found greedy realtors from out of town. Now, your listeners in Vancouver, this gets even better because the marketing company for this developer is based in Vancouver, British Columbia. The same techniques that are used in Burlington, Ontario are used in Vancouver, British Columbia. They're used in St. John's, Newfoundland, Montreal, Quebec, and Edmonton, Alberta. They're the exact same strategies used by builders for the last 30 years. The question we all must ask is, CMHC approves the financing on these buildings when they're built. CMHC is financing inflated new home construction numbers because the builder inflated the price to use as an incentive to realtors to hoodwink Canadians into buying a home, whether investment or for themselves. The home will then need to appraise at this elevated value in order to secure CMHC-backed insurance against it. Whether it's caviar or oysters, black tie or fancy cars, if your realtor is not disclosing to you what the previous price of the property was worth, what it would currently appraise at, and what valuation it's going to be upon completion, which could be 2, 4, 6 or more years out from now, you can charge them under provincial trading legislation if they didn't disclose the price was increased in order to facilitate them getting commission. It is my belief, Jim, it is my belief this is an anti-competitive practice, and I do not believe that if the provincial regulators were provided the documentation that they could not charge every single realtor who sold one of these units subsequently to an innocent Canadian home buyer or investor. So yes, these black tie, oysters, caviar, fancy cars, when the median realtor doesn't even sell one house a year, folks, they get a chance to make $20,000, $30,000 convincing you by selling you a brand new unit inflated in price for the builder in order to facilitate them getting commission. Yeah, that's price inflationary.
We'll have more with Ross Kay right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, a new REIT is supposedly being launched in Toronto in an IPO that states the gold is a 2% yield on the investment. Are those types of deals responsible to consider in 2020 in these seemingly low returns on your money? 2%?
2%. They're going to have an IPO. You're saying they're going to have an IPO on a REIT, I'm assuming, with a 2% yield. This is the lunacy at the end of a trading cycle. This epitomizes all of the damage that's been done since 2013 because the public isn't simply told the truth. So right now, for investment real estate, you're working at about a 5.4. Now, what a 5.4 means is if you invest $100,000, if you invest $100,000, you've got to get about $540 a month out in rent, okay, to make the investment sensible. That's what it means. So what that means is if you've got a $500,000 piece of real estate, $500,000 worth of real estate, you're looking somewhere around $3,000 a month that you've got to get rent. Now, for a rational real estate investor on a single property, probably not going to take place. Okay, if you had a $500,000 property, you're probably not going to get $3,000 a month rent. You're going to have to take less than that. So, which is why we would tell you don't invest in that $500,000. What you're looking for in that case, especially with the new legislation that is in place in certainly British Columbia and Ontario, you want to look at a place where you can have multiple rents out of a single property, a place where there are two separate living quarters, because then your 5.4 is very achievable. You're going to have a 5.4, which is going to return you somewhere between 6 and 8% a year. So when we see these numbers, a 2% yield, like when someone even contemplates releasing a REIT at a 2% yield, clearly someone is taking all the profits and skimming it off the top and looking to offload the risk to some innocent investors. It is the worst type of real estate investment that you could ever make. You need to get out to your financial advisor as quickly as possible and ask them what they can do above 2% on a zero to no risk situation. Because I'm telling you, a good financial advisor or financial planner or wealth management professional is going to be able to do that. I don't even know how someone could offer what you're stating, Jim, a 2% yield. It is virtually impossible for an investor, a true real estate investor, to get into investing in residential real estate and not see a 6 to 8% compound annual growth rate on their money. It is virtually next to impossible. The only reason you're going to do it is because you're investing in real estate you shouldn't be investing in. It means you're buying properties that are never going to, at the time of the market, where they are never going to generate revenue. So let me leave this with your listeners today. The reason why rental real estate is such an awesome thing for our society is because you get landlords who purchase the properties when the properties are at the low part of the cycle. In other words, landlords who buy real estate 2010, 2011, 2012, 2013, they're buying it at reduced prices versus what it's going to be at the top of the cycle, 2016, 2017. Those landlords then in turn are able to lease those properties out looking for return based on what they originally paid for the property. I don't think Canadians understand how many homes were closed on in 2008, 2009, 2010, while the Great Recession was ongoing in the United States, closed on in Canada here. Homes that had been purchased years before, 2004, 5, 6, closing in 8, 9, and 10, closing for prices that they were purchased for 3 and 4 years ago. Those homes immediately became available in the rental housing stock. In Ontario, when they were first rented, rents only go up with inflation. The landlord is tickled pink. The landlord purchased the property with the right timing when housing prices were at their lowest. They are now able to then in the meantime, they benefited for decreasing interest rates on the mortgages that were going to carry them with. And their annual rate of growth went from 6 to 8% to 10 to 12%. And they were able to do that without the house price going up at all. They were able to do that with only increasing their rents with inflation. All of these false rental market comparisons that we hear out there, I think your listeners can use their own common sense. If rents were really as crazy as what is being reported in the newspaper, the vast majority of these tenants would have no place to live, because the place that they previously had rented, they could no longer afford. The landlord would have kicked them out, because the landlord would have magically found a new tenant. Of course, there are not massive former tenants homeless across this country, and especially in British Columbia and Ontario right now, because that never happened. The landlords purchased the real estate at the low part of the cycle, and then they rented it out on those prices that they paid. They may cash out someday, selling at the peak of the market, which is a different type of real estate investment return, but most of them have no desire to ever do that. They're just going to keep that rental property until the day they die and collect rent from it. The reason these IPOs are coming at a 2% yield, Jim, is because they're asking people to purchase these properties at peak price, at a timing when a real estate investor should not be entering the market. We have people in our investing programs right now, Jim, with money to spend. We have properties that easily could return 6 to 8% compound annual growth rate on their money. Okay? They are all over the place across this country. They're available. But why would they do that when the prices are dropping in the meantime? Why wouldn't they seek to get in the market during the trough? Why would they get in at the peak? When you see a REIT being offered to you with a 2% yield, when for decades you could get into a REIT that would pay you 6 to 8%, it's a red flag, folks. Your financial advisor needs to be consulted immediately, because I can tell you the pro forma that is available on that REIT will not show that it's a good investment. It is not going to show that. They are now going to try to sell this REIT based on negative interest rates. That's what clearly is going on in a case where you hear something being offered on a 2% yield. They're basically going to be forecasting negative interest rates, because that is the only way these REITs will get into the 4 to 6% yield. Just stay away from them, folks. If you want to get into real estate investing, there are way easy ways to do it. You don't need to be buying a REIT on a 2% yield. Wait till you see the yields back at 6 to 8% and get in that.
Ross, thank you so much for chatting with us.
Thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross or any of our other guests, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.